Shane, how's it going?
Kyle, it's going, man. How are you today?
Could be better. It's August, and it's always nice to see a market that's trending in the right direction, but August is a pretty uneventful month, and right now we're just seeing it kind of sell off, chop, nothing special.
Wait, what's the right direction, up or down?
I like up. It can go infinitely up, but it's limited at zero on the way down.
I'd rather see it trend in alignment with economic realities. I don't care which direction that is, but it would be nice if all that hard work we did earning our CFA credentials would would have been worthwhile, and that the fundamental analysis would actually be meaningful and give us an inside edge on the direction of the market. What really bothers me is when the thing trends in ways contrary to the economic reality, like it's been doing all year this year. Don't get me wrong, I love seeing people make a little bit of money, but it's frustrating when what you see doesn't align with reality. So that's what I say is the right way. The right way is the way that matches up with reality,
Hmm.
up or down. And so for the past, what, 3 weeks now, I'd say we're going the right way, which is unfortunately down. Not saying it's good for people to lose money, but market's what, about 5% off of its highs.
It
That's
is.
the first 5%. It's actually the first 3% drawdown in the S&P 500 of the year 2023. And here it is already August. So market won't go in a straight line down, probably, although it went mostly in a straight line up since about February. But I think there's a lot more downside to come if the economic reality is finally starting to matter. Really, maybe it's just the fact that Apple is going down and Microsoft is going down is maybe the only reason that the market's going down, because those two represent such a huge chunk of the benchmark indexes these days. So who knows why? Um, but it's good to see a dose of reality setting in, maybe.
Yeah. And we'll see if it continues or if it's a temporary pullback. But yeah, with that, let's go ahead and jump into I guess the most recent market commentary you put out, and then we'll do a little bit of a look ahead as well. But with that, anyone tuning in, please like, subscribe, give us comments, feedback. Love doing this and having you guys interact with us. So let's go ahead and jump on over to the commentary. All right, Shane. So you're kicking it off here with a conversation on Tupperware. So why Tupperware?
Yeah, well, it's just I think it's a good example story of kind of the times that we're in, where the company can be on the verge of bankruptcy. Its stock can be worth zero intrinsically, but yet it can rally to crazy levels. Like uh, Tupperware gained almost I think 900%, which is 10x in just a few days' time, with the company on the verge of bankruptcy and no real news kind of going on for it. So company should probably be worth zero. And it's not the only one. Obviously, we've seen a whole bunch of companies go to zero this year. Later in the commentary, I mentioned, Bed Bath and Beyond and a couple of the banks, which is not all the banks that actually went out of business so far this year, but um, it really all leads up to yellow. But yeah, the if you want to scroll down a little bit, I do have a Tupperware chart. So like, Tupperware gained 900% in a few days' time, but that 900% barely even shows up on this chart. I mean, it's been trending down for so long that this right here is a 900% gain. It's like barely a little pop, you know? And so, who knows? I don't even know how much that rally was, but from, basically $5 or something to $35, that's a pretty big rally too, only to roll over and drop way down afterwards. So a 900% rally is all you'll hear about when you turn on the Cartoon Network over there at CNBC. They'll be talking it up on the day that it's going on, but they don't tell you that it's still got to go up another 16 or 17x just to get back to even.
Hmm.
Um, so that's how math works.
Yeah, and you bring up a good point with the news networks and covering, what happens in the market. They want viewers. So you always have to remember this, they'll highlight names that have moved up a ton. And then oddly enough, when it's a bear market and everyone's panicking, they bring on the most bearish bears out there to get more viewers. So can really kind of, play whipsaw with your emotions. So important to remember that when you see these moves.
Yeah, that's how all media is. It distorts reality, whether it's social media or traditional media or sports media, news media, it's all the same. And so you got to be careful what you let that do to your emotions and your basic understanding of things. But yeah, ultimately, this led up to Yellow, the trucking company, which of course filed, I think said they were planning to file bankruptcy. I don't know if they finally did file or not, but they're going bankrupt. Stock should be worth zero. And, the thing went up 1,057% in 4 trading days. I'm gonna go look at it right now and see what it's doing.
Yeah, and then
Oh,
I just
oh
stopped here.
gosh, I haven't looked at it, Kyle. It went up. Oh, what do you think it's doing now?
Up
Since
100%. That's probably reasonable, right?
since it went up, so it went up 100 or 1,057% to its high on August 1st. Since that high on August 1st, as of right now, it is down 80% back to $1. It trades at $1 and 10 cents right now.
Yeah.
Oh,
And
sorry, it's not even trading. It's done trading. It's delisted. It's off. It's now under YELLQ. So it's bankrupt. That
and
happened yesterday.
here's the big thing. What on earth is happening here, and how does this make sense, right? They were up 163% when they announced bankruptcy, or
Yep.
it was in the headlines anyways.
Right. And now it dropped and I gave back 80% of that. I mean, seriously, if you had bought it at those highs, but that's just unbelievable. I mean, I knew it was going to happen, right? When I'm writing this on whatever day it was I wrote it, it had pulled back a little bit, but it went all the way up to $5 from 43 cents to $5. And now it's $1.10.
Yeah. So
But I
yep.
haven't seen anything about it on CNBC since it was rallying, 1,000%. It's off the rotation now.
hmm
Unbelievable.
So, and then here's a list of some other ones that went down to zero. So it's happening out there. But Shane, you highlight the big one: fundamentals versus what the market's currently doing. Bankruptcies are not a good thing. Uh, looks
No.
like we're seeing quite an increase here that you highlighted.
Yeah, I mean, we're actually on pace for I don't know, a lot, right? Like we're going back to 2010, 2008, 2009 financial crisis times, and we're already at 402 for the year. I don't know how many we'll get for the rest of the year. I guess this was through July, so a little bit. So it's probably not going to be 804. But if there could be more bankruptcies in the second half of the year than the first half of the year, there's no reason it has to be less.
hmm
It looks like most commonly it is, just because there's fewer months between, August, there's 5 months instead of 7 months. So should be less. But if interest rates continue to go higher, the instances of bankruptcy are probably going to accelerate, not decelerate.
Yeah.
So who knows?
And that's one thing we'll hit on it later. You have a chart of the 10-year, but right now, 10-year interest rates, they're definitely going higher. And that's not going to help any struggling business or anyone trying to get longer term financing right now.
Right. And the yield curve is starting to steepen too, which if you look at prior commentaries of mine, you'll see that the the spreads steepen into a recession. So, yes, the inverted yield curve is bad economically speaking, but the recession doesn't normally arrive until it starts to steepen. And now we're in that steepening pattern, it looks like. So I think there could easily be more bankruptcies in the last 5 months of the year than there were in the first 7 months of the year. Even if you look at that, actually leave that chart there for just one more second, Kyle.
Yep.
I was just noticing at the bottom, it shows that in 2023, they're trending higher. It's not flat, right? And we haven't seen it really tick down. I mean, obviously March was the big one. But it's if I were to draw, you know, a line there, a trend line for that, and do like a regression analysis, that line would be sloping upward,
hmm
So unless something changes in the last 5 months of the year, which so far since I wrote my commentary, the interest rate situation has worsened, should lead to more bankruptcies, not less.
Yeah. And I'd be curious too, just to note, you can always look at data in different ways, but when I'm seeing this, we have an absolute number of companies. And obviously, we would have more companies 10 years later than we did in 2010.
Mhm.
I'm just curious, as a percentage of companies, if it's an increasing percentage of companies filing for bankruptcy.
You
So,
know, I don't know if that'd be that obvious because there's been a lot of consolidation in a lot of industries,
yeah, I
where a
guess
lot
so.
of bigger companies are buying the smaller companies. And I know that there's been way fewer IPOs than normal over the past several years. And I think last time I looked, the number of publicly traded companies, the number of ticker symbols we could trade is down materially over the past couple decades. So I don't really know. I wonder about that.
Yeah, so something to consider there, but that
Mhm.
does make sense with consolidation. It might actually just be a wash and it could be the same. So we'll see, but
Check this out. I
um,
just Googled it. The count of publicly listed companies traded on US exchanges has fallen substantially from its
hmm,
peak in 1996. Back then, there were more than 8,000 companies, and today the count has dropped by more than 50% to only 3,700 companies.
interesting.
Yeah.
So, well, when we're talking about those publicly traded companies, the biggest thing we want to look at a lot of times is the S&P 500, and that's what we have up now. And Shane is, we were talking about, we're seeing this pullback. We were overextended. That's my view. I'm not the least bit surprised to see a pullback here. The question is going to be, are we going to continue pulling back? And the first thing I'm looking at here is your 50-day moving average. That's the red line. If we go below that, then I start to wonder if maybe this is the top for now, and maybe we do make a real move lower. But I think as long as we kind of stay in this range, I'm still a bullish thesis on the fact that I understand fundamentals well, but I'm more of a technician and price is trending up. So I'm gonna, stick with that as long as it continues to go the right way.
Yeah, I guess
So,
that's one way to do it, man. I can't get bullish about this. I think we're still in a bear market. Um I don't see any reason to declare that we're not in a bear market anymore, especially given all the economic indicators. I think price can get ahead of itself a lot of times, and so the market deserves to be way lower. I mean, it deserves to be way lower. It's not even. I can't even understand how it's up here, other than people like. I don't think it's I don't know. I think it's more like people just saying, "Well, if it's gonna go up, I'm gonna have to buy," and they're doing what you're doing. They say, "Forget about the fundamentals. I'm just gonna buy because the market's going up." And then once everybody who is willing to do that has done that, and there's nobody left to buy and put their money into this, to this market with the underlying structure that it has, that's when it'll break and it, stairs up and elevator down, man. I mean, if we
mhm.
if we looked all the way out here, it was a steady stair step all the way to the top, and then bam, and then we're gonna do it again, and then bam, it's gonna drop. If that's what's gonna happen, it's probably gonna happen fast. And if that's gonna happen, this is nothing. There's a long way to go even to get to the 200-day moving average. And is the economy in any better place than it was back in October of 2022? I don't know. I mean, inflation's still higher than the Fed wants it. Monetary policy is more restrictive. They're reducing the balance sheet. They're still hiking interest rates. And that they want to see their student loans are going to have to start coming due. There's a whole bunch of reports out there, which I'll end up talking about in my next commentary. So I guess I'm jumping the gun, but whole bunch of info out there about people who are, they're going to have to choose between putting food on the table and paying a student loan back, or paying a car payment or paying a student loan back. So I don't know. I think we got a lot lower to go. Although I don't think it will go in a straight line down, just like
Hmm.
it didn't last year. Everybody thought the bear market was over here, and everybody thought the bear market was over here, and everybody thought for sure the bear market was over in August, and then bam, we dropped to a fresh low. So
Yeah.
I don't think the bear market's over yet at all.
Yeah. And I think the big thing there is always, so the fundamentals right now do not paint a good picture, but with the markets, it's interesting is how much timing plays a critical role in, beating the market. So it's one where those fundamentals might not catch up until next quarter, next year. Uh, we'll see on that one, but the biggest thing of all is just managing that risk. So you talked about it
Yep.
last time, but trailing stops, that's how you're able to participate in this rally and not have to worry so much about trying to predict what the market will do.
Yep. And Kyle and I don't share a brain, so we got our own opinions, and it's fun to wrestle with smart people who don't see things exactly the same as you, because if everybody thought the same as you, what the heck would we need you for?
Yeah, exactly. And Shane, you highlighted here. So, Apple, it's been the best stock you could own. Just all, it's working its way up. That's awesome. But you dug a little deeper and tell us what you were seeing.
Yeah, well, I already kind of hit on it, just mostly like, this is a big part of all the indexes. So it's what Apple does and what Microsoft does. Probably the index is mostly going to do. So that's an important aspect of this. But also, um, let's see, Apple reported third consecutive quarter of declining revenue. And so, it's not because they lowered their prices. They're not selling you an iPhone for half as much. There's just less demand for their product because, again, as people are feeling the impacts of this inflation and their credit cards are maxed out. One thing I don't need is to upgrade my iPhone every year. I get the new software for free every year. Feels like a new iPhone every year. So unless this thing goes in the pool, which I mean it can survive that now too. They made them pretty good. It doesn't break every time you drop it. I don't even have a case on mine, and it's fine. So, people just don't, when you look at all the different things you have to spend money on, they're just not buying as many iPhones.
Right.
Um, and so, the fundamentals that underlie Apple are such that, if they don't, if they're not selling more, it's not worth as much, and the multiples just don't agree. Like suddenly people are paying a higher and higher multiple, and I think I get into this a little bit lower, but they're paying a higher price to earnings and a higher price to sales for a company that's selling less stuff. Like those things don't agree, and
Hmm.
they're likely to revert at some point, and either the growth will reaccelerate and everything will be fine, or those multiples will continue falling. And there you go. There's a chart. So you can see here, this red line is trailing 12 months operating income, but the multiples, the blue and green lines are going higher. Price to earnings and enterprise value to EBITDA. Those are going higher and higher. And same thing on the revenue side. So price to sales is going up while revenue growth is declining and actually is negative, right? So why would you pay a higher multiple for a thing that's doing less business? You wouldn't do that for an ice cream shop or um, a restaurant of any kind. Like you wouldn't pay more for less. Nobody would willingly do that. And so either the growth is going to have to resume and the revenue is going to have to keep growing, or those people are going to figure it out and they're going to say, hey, I'm gonna go buy something else. And of course, Apple is down now. How much is Apple down from its highs? Let's see. I said it could easily go. I said I could make a case for 165 when I wrote this. It is currently 174.85, so we're almost there. Apple is down 12.31% from its high. That was back on July 19th. And it would have to drop another $10 or about 5% more to close the gap that I see on the chart down at about 165 I guess it's 166. So I think there's some more downside to come in Apple. And of course, if it wants to drop all the way to the 200-day moving average, that's right around 161. I mean, to be honest, we'd probably be buying it there.
Hmm.
But even from there, the revenue needs to start growing again. Otherwise, it ain't worth that either.
Right. I tend to agree with you there. And then, you know, I guess if we can flip the page now, back to focusing on the Fed. Are you ready for that one?
I was born ready, Kyle.
Perfect. So I have to, give you some applause on this one. I think your timing on when we were going to hit a positive real Fed funds rate, you were right in there, kind of that, I think, May, June
Yep.
timeframe.
Yep. We've been
Um,
talking about it on this call since I think September or maybe August of last year. So for over a year, we knew. I mean, we thought we knew how it was going to play out, and we were pretty darn close.
yeah. So that happened right here in May. So
Yep.
went positive about 1%. And the
And
big
and
thing,
what we said though is that that would lead to a pause in the interest rate hike cycle, and
mhm,
that certainly is what happened. The month after it went positive, they decided not to hike rates in June. You can see they got the little X over there next to June. So this shows that there was a meeting. Oh, sorry, up here. Yeah. There was a meeting in June and they did not hike rates. So um that was dead on accurate. And of course that the market in anticipation of that has kind of just rallied all year. And I think that's mostly what's driving the rally higher, but it's I don't know. It's kind of like it just doesn't that's not the primary concern, I don't think,
yeah,
like the rate of change in the overnight rate is important, but it's not the most important thing in the economy. That is, however, what the headlines and the financial media have all been focused on instead of looking at the earnings recession and the S&P 500 stocks or many of the other economic indicators that I think are a little bit more indicative of the environment. So
yeah. And I think, just a good analogy, it's like brakes on a car. So when you're up here and the real Fed funds rate was negative, that's like you hit the brakes and the car's not even trying to slow down. And then here, as it gets positive, the brakes are catching, things are slowing down. It doesn't mean you're stopped, but you're not accelerating anymore. So it kind of catches up in time where you slow down. Things might come to a halt, but they'll certainly slow down, and it just takes time. So the whole impact of all these hikes, we're not going to know what that really does to the economy, the markets, everything for a little while. It's not like flipping a switch.
no, and we talked about that on the last call. So if you didn't watch the last chat, go back and check that out. We talked about when the impacts will start to happen. So I don't know how much more we want to go through this one. Oh, this was terrifying for people who didn't read this by Mr. Steiner over at Hedgeye. Should look at that. It's that's some economic reality for you right there, and it's terrifying for the future. So um, I would definitely take a look at this if you haven't already. You can find the market commentary on our website. You can see the address up here, and I would encourage y'all to go ahead and read that and subscribe to it too. There's a little subscribe box somewhere we already passed, and you can put your name and email address in there and get the commentary in your inbox when it comes out every month.
Yep.
So yeah, let's scroll down real quick just and see if there's anything else we want to hit in here. Um,
You got a few
yeah,
charts here.
yeah, and these are charts that we went over on the last call for the most part. I don't know if there were any that we didn't go through on the last Elevate chat. I think we looked at, maybe we didn't look at the credit card debt ones, but
Yeah, I don't think
credit
we hit the student loans, but looking at the
delinquency rates are
delinquencies,
ripping.
yep, except for student loans, but now those are about to resume. So
Like, you know
we'll see
what's
what,
interesting about that chart? If you want to, can you click on the delinquency 30 plus days? So these slopes right here uh are like more aggressive than they were during the great financial crisis back in 08, 09. Um, I don't know. I guess maybe this one inflected a bit. The credit card debt inflected a bit at the end, but when it started out, it was like this. You know, the right now it is like zooming higher, and I think it's just maybe getting started.
hmm
If that's the case, and then if student loans, when they become due, are going to do that, look out. There's going to be more bankruptcies coming on a personal level, and as those people stop spending money, the companies that they spend money at are going to have to let people go. The people who get let go are then going to have a hard time paying their auto loans and credit cards and student debt and mortgage, and they're gonna default. I mean, that's what happens when you tighten to the point of being restrictive. It's supposed to slow down the economy. Unfortunately, the consequences of that are people are going to file for bankruptcy, and then companies are going to file for bankruptcy, and then banks are going to file for bankruptcy. What was
Yep.
super abnormal was back in March when the banks were filing, we're going to zero without any of that other stuff happening. So that's a little terrifying if you really put it in context.
Yeah,
So,
it's not something that's too common. So, with that, Shane, you want to go ahead and flip it over to some of our forward-looking slides that we've picked up?
yep, let's do it.
All right, so looking forward into the commentary. First up, so Shane, we talked about this, but here's the trend channel we're in on SPY. So we'll go ahead and just bypass that, but you can see now, here we
Now
are.
we're below.
Now
Yep.
we're below the 50. So that does mean something, but I'm looking right over here about 3 weeks ago, or no, that's about a month ago. We had a little dip. So kind of right in that 439 level. See if we hold
Right
that.
here.
But
You're looking at this. I can see your mouse, but I bet you the people watching won't be able to. So I
yep,
just
it's
drew
that
that for you.
line. So right there.
But yeah, we're now underneath the 50-day, which is the intermediate term trend. So the trend is, the 50-day is still kind of trending higher. 200 days still kind of trending higher. But the price is now below and in between them. And so now the 50-day should be resistance. We'll see what happens. But yeah, we're down a bit more today, and this screenshot was taken, I don't know, midday here on whatever day it is. August 17th, maybe? Is that it? 17th? I think so.
Yep, 17th.
Yeah. All right. Anyway, so that's where we are. And here's the interesting thing I was looking at the other day, like uh, the equal weight S&P 500, which takes 500 companies, and it takes 100% of the money and divides by 500 companies and puts the exact same amount into each one. So same amount in Apple, same amount in Microsoft, same amount in XYZ security you've never heard of, because nobody knows all 500 companies in the S&P 500. In fact, I'm gonna go look. I think I can get this pretty quickly, but I looked the other day and there was like, I don't know, 30% of the S&P 500 was in the top 10 stocks,
Hmm.
roughly.
And
Number 200 is Biogen. It gets 0.10%. Meanwhile, Apple gets 7.09% and Microsoft 6.5%. So the top two stocks get 13.5% of the money in the S&P 500, and the number 199 and 200 biggest allocations get 0.20% collectively. So the orange line is the normal S&P 500, which is market cap weighted. The biggest companies get the most money, essentially. And the smallest companies basically have no influence. Like the smallest company could quadruple and it wouldn't have any real impact on the overall index. Whereas this blue line just puts, all 500 companies on an equal footing. And since the highs in February of this year, um, the equal weight S&P 500 index is actually down almost 3%. And this was as of a couple days ago, so it's probably closer to down 4% now. And the S&P 500, the regular one, was up almost 7%. And it's trended down a little bit since I did this too. But that's a pretty big disparity, because normally you see these in the beginning here, these were very close. And then it wasn't until the banks started to fail in mid-March that everybody was like, you know what? I'm putting all my money into Apple and Microsoft and the big seven stocks, the Nvidias and the Googles and the Amazons. And pretty much the whole rest of the market has not done anything.
hmm
And the problem is, I know I can hear you want to say something, but the problem is people see these benchmarks and they're like, oh, my account should be up, 17%, just like the index. And it's like, only if you put all your money into about 7 stocks, just like the S&P 500. People think they're getting big diversification in the S&P 500 or in the NASDAQ 100, and they just aren't. You'd be better off just going and buying outright, those 7 stocks or even 10 stocks, whatever you want to call it, and paying no fees rather than paying, the SPDR company State Street, maybe I think that is, 4 basis points for the privilege of basically still just owning Apple and Microsoft.
Yeah. And that's one thing, I always tell people is market cap weighted is nice because you can end up in a situation where you own more of the best companies. So like you said, that could be Tesla, Apple, and less of Domino's Pizza. It's listed, but you probably own a very small percentage of that. But when you look at this, it's like, well, if you're going to define the market, this is probably a better indicator of what the market's doing because it is measuring all of the companies more on like a percentage change basis, right? So it's telling
Mhm.
you overall they're not really moving. It's just that some of those larger listings in there have really gone up.
Yeah, and the cap weighted, I mean, it might lead you to own the best companies, but it also might just lead you to own the most overvalued companies, you know,
Hmm.
like Nvidia trading at 200 plus times its earnings. Like, is it really? Yeah, it's a good company. Like, it's a great company. It's probably worth 10 times earnings, but it's not worth 200 times earnings.
Right. So something to keep in mind when we're looking at the overall picture, but we'll go ahead and move on here. And you brought this one up, but just looking at passive strategies. So we always need to differentiate, active, which is trying to kind of pick the winners, move some money around versus passive. And that's just allocating to some benchmarks and just letting it work, not doing anything. So Shane, what are your takeaways here, I guess?
Yeah, well, this isn't meant to be a commercial for any strategy that Elevate operates, but when we put together passive strategies for our clients who say, hey, I don't want to try and time the market. I don't believe you guys can do, active management. I think you should just buy the market and hold it, and over time it'll go up, and that's cool. And that's what most companies do. We do offer an option like that. When we do it, we use Vanguard funds because they're ultra cheap. They're way cheaper than the iShares and the SPYs and the I guess the more prevalent ticker symbols. So Vanguard's known for being low cost. These strategies, putting this percent in this ETF or this percent in this ETF, only cost about 4 basis points. And in here, I didn't add any type of management fee. Most companies, whether it's Edward Jones or Merrill Lynch or Bank of America, whatever, you know, Fisher Investments, they'll charge you a 1% on top of whatever the ETF fee is in order to build basically this pie chart of ETFs. And then they don't really manage it. They don't say, hey, let's own less S&P 500 because we're bearish on the S&P 500, and then let's own more bonds because we're bullish on bonds. Like, the conservative strategy will stay conservative even when the asset manager is aggressive and optimistic and bullish. And the risk seeker, we call this risk seeker because it's more aggressive than the aggressive strategy, but the risk increases as at a faster rate than the potential upside increases. So these people are not risk averse. They are risk seeking. They say, hey, I don't care if I'm taking 10% more risk. If it's going to get me 1% more return, I just want the 1% more return. And they're not worried about the risk versus return. So we call them risk seekers at Elevate. And this is, the risk seeking pie chart is 95% in stocks and only 5% in bonds. So it's quite aggressive. Anyway, the point is this is the standard way that most money managers manage money. They don't manage the money at all. They build you a pie chart of funds. Vanguard manages these funds, not your guy. And then what your guy does is he manages your expectations and says, here's a risk tolerance questionnaire. We'll put you in the passive strategy that most accurately reflects your risk tolerance. And then we just tell you to stay in the market, and it's time in the market, not timing the market, and all these clever sayings that they have. And then they'll do all types of research to prove to you that it's not possible to time the market. And I agree, it's not possible for most of those guys to time the market because they'd rather go out and play golf and meet new clients and gather more assets, and they don't have time to actually actively manage the money or sell a covered call option versus a stock that's overvalued but they still like. That's just most of the industry. Like,
Hmm.
I don't know if I don't know if this has been your experience, Kyle, but a lot of people in this business who call themselves financial advisors, they failed at everything else. They dropped out of college, they couldn't sell real estate, or couldn't get their license or whatever. And for better or worse, the Series 7 test isn't really a hard one to pass. Series 65 maybe a little bit harder, but it's certainly easier than going to college for like 4 years. So, the industry is, there's a lot of really great people in it, don't get me wrong, especially the CFA charter holders, wink, wink. But there's a whole lot of people who really don't have any idea what they're doing. They're just glorified salespeople, right? And they're like, here's your pie chart, here's your risk tolerance questionnaire. Don't worry about it when the market goes down, it'll come back. By the way, do you have any more money to put in? And
Yeah.
that's just how it mostly works, for better or worse. And we tend to do things a little differently, but we do have clients who say, hey, I don't want to be active either with my entire portfolio or maybe a couple 100,000 of my portfolio or whatever. Anyway, the point of this is to show that a lot of people are running around talking about their year-to-date gains. You know, the S&P 500 might be up 15%, but an aggressive strategy that has 34% in the S&P 500 and 7% in mid caps and 4% in small caps and 20% in developed markets and so on down the list. That's up about 8% this year, which is, it's a good annual return to be up 8%. That's not a bad deal. But here's the problem is last year that same pie chart was down 15.
Yeah.
So they're not even back to even yet. And, people are running around talking about how much they're up this year. Well, you're still way down from where you were at the end of 2021. And, you know, year to date just doesn't matter. It just doesn't matter. So, for people who are stuck in these types of pie charts and want to understand a better way to we think to do things under active management, um, there are other ways. But as far as pie charts go, if a passive pie chart strategy is kind of what you prefer because you think it's impossible to time the market, the most important things are, well, it's just to pay less money. It's a
Right.
commodity product, right? So if all you want is the market return minus a fee, the most important thing is what is the fee. So you want the lowest fee possible, which is Vanguard funds. And you want to basically go in and tell your advisor, like, hey, I want you to cut my management fee in half because I don't really see it doing anything compared to what an active manager would do. And
Yeah.
so you should pay
And
less.
and something good to know in that is if you're going to be passive, the expense is a big issue. You want to watch that. But then when you talk about active, it is, I think 20% of active managers are able to beat the market. But much like a company's sales force, usually it's the top 20% that make all the money.
Yep.
So that's not an unusual statistic. But then there's the other component of, not just beating the market, but what does it look like in how you just manage the money? So right here, last year being down 16%, if that was okay, maybe that's just fine and passive works. But maybe on the active side, if, on the upside, if it's still 7.6, but last year you only lost 10%, that
Right.
looks pretty good on a risk adjusted basis and helps you, on your way to retirement to avoid those large drawdowns.
Yep.
So always more than one way to look at it.
You got it.
So with that, we'll step to the scary chart of the day. So the 10-year treasury right now, you don't want to buy a house, borrow money, do any of that. And this chart right now, I just want to buy that and watch it go to the moon, but that's the wrong thing to do right now.
Yeah, it looks like it's probably gonna break out and go higher. I don't know. Freddie Mac mortgage rates come out, I think, later today. I don't think they're out yet. I was gonna look. I should have looked before we got on this call. But this is what is this? The Mortgage Bankers Association rate. And yeah, August 17th. Okay, so Freddie Mac is out and it's up at 7.09, which is up from 6.94 or 6.96 or something last week. So this one, yeah, I mean it's right back to the highs that we saw earlier. And this, yeah, is the Mortgage Bankers Association 30-year fixed rate mortgage with conforming loan balances, so less than 726,000. This is what It's what it looks like if you want to buy a house right now, and holy moly, that makes it expensive. So, um, yeah, not much else to add there. But
No.
if it breaks out, 8% on tap, pretty short order, which is wild.
Yeah.
It's actually not even close to the top
It's
end of the range though, going back
I,
to 1980s, right? It's like in the middle.
yeah, I know you know, guy I know Ralph Akampora, big market technician, his first house he bought, he always tell me he thanked the banker when he got 18%.
It's
So
crazy.
it can go a lot higher than that.
It
Hopefully it
can.
doesn't, but
It can. It's funny that that hasn't had more of an impact on home prices, but there's so little inventory that
mhm,
prices are staying high despite the rates going up. That's kind of confounding.
yeah. And it looks like maybe buy or it's feeding through in a few less purchases. Is that,
Yep.
am I
Yep,
interpreting that right?
that's how you read this. So this is it does not measure the number of homes purchased or closed loans. It's simply a report of mortgage loan applications. So some of these will be approved, some people make more than one application, all that kind of thing. So this is not translate directly to home sales, but you can see like this goes back to the end of the financial crisis times. Like there's not as many mortgage loan applications going on as there used to be.
Hmm.
Certainly we didn't get any as high as we were at the peaks of the, you know, the big short type mortgages where you could get a mortgage with no job, no income, and no assets. Um, we never got back to that peak either, but this is kind of a wicked fall as rates have risen. Mortgage applications are down substantially, and you'd think like you would think that that drop would translate to lower home prices as people try to get their house sold, but I don't want to. Even if I wanted to sell my house and move somewhere, I would not. I am not trading my 2.9% mortgage in for a 7.1% mortgage. I'm not doing it.
Hmm.
We're stuck here now. Like, we're not going anywhere.
Yeah.
Um, and maybe I'll live to regret that. Maybe 5 years from now, I'll be like, you know what? We're just gonna bite the bullet and move, and I'll get a mortgage at 15%. I don't know. But as it stands right now, I can't handle the thought process that I would have to go through in order to like just pay that much more interest on a home loan. So I'm not alone in that. Most people um, probably feel similarly unless they, hit the lottery or got promoted to some kind of job that, quadrupled their income. Maybe they don't care as much. But
Yeah.
those very few of those people out there.
Yep.
So
Makes a difference. So,
yep.
and then this one, is this the one bright spot, Shane? It's the Fed
I thought
manufacturing index.
it was really interesting. This data just came out this morning. It's not often that the results are so out of alignment with the forecast. Like that is a big, it's not like it missed by, it's not like it came in at down 5 and forecast was down 10 or down 2 and the forecast was down 10. This thing was up by more than it was expected to be down. And that was the first month that it was up since going all the way back to, I don't know, what's that? October, September, a year, August of last year. So, yeah, the Philadelphia Manufacturing Index. Just a, I guess, does it say on here? Does it give a better? They did report a decline in employment, but basically it's just a manager survey of business conditions, right? The manufacturing survey. And so that's a positive. It's an outlier and it's a surprise. And so the interesting thing though is that that didn't send the market higher. I tried for a little bit in the pre-market, like there was a little bit of a bump when this data came out. Um, but then I think the reality set in that like if that's true, the Fed is actually more likely to raise rates again when they meet again in September to cool down this economy.
Yeah.
So, good news is bad news now. And like we're almost in that cycle where like everything's just going to come out and be like, oh shoot, they're going to keep hiking, and if that's all the market cares about, then the market's going to end up trending lower. So this was a bit of good news that sent the market lower today. So maybe we're kind of seeing a changing of the guard from what we've seen so far this year.
Yep.
Because generally the data has been terrible and the market went up. So now we get some good data and the market drops. We'll see. It's a small sample size, but that's what I saw this morning. I thought was interesting.
It is. So, with that, we'll go ahead and I think wrap it up, Shane. Flip, we got a Babylon B article here we can take a look at, but I thought this was pretty important.
Crack me up. If anybody doesn't know who Dave Ramsey is, obviously you should Google that, check him out. I don't agree with everything that Mr. Ramsey thinks as far as financial planning goes, particularly when it comes to whole life insurance. I think he misunderstands that by a lot. But as far as debt and how to treat debt in your life, he's like the debt czar, and I would agree with him there. You want to
Mhm.
you want to cut up the credit cards. You want to use the envelope system and put cash in an envelope. But once the envelope's empty, you don't have any more money to spend. Don't go onto a credit card. So that's his main shtick. And so this from the Babylon Bee cracked me up this morning.
Yep, that's a good one. So awesome. Well, Shane, thanks for taking the time today. Look forward to doing this again. So
Yeah,
I'll
my pleasure. We're like sorry to interrupt. We're like, I don't know. We're really only about a week beyond. So my commentary came out last week, I think on Tuesday, maybe Monday. I don't remember exactly when it got posted. But you know, we're trying to do these calls 2 weeks after the commentary comes out, and that would also be 2 weeks before the next monthly commentary comes out. So we're a little bit off schedule still, but closer than last time, I guess. And my commentary for September probably won't come out for 3 weeks from now, till maybe so the 7th maybe of September would be 3 weeks from now. So you guys will see that then. Some of the slides that we just went over, the past few minutes, will probably find their way into that commentary. And there'll be some more stuff that I'm going to discuss about. Like I said, there's this new Credit Karma report out where they surveyed a lot of people who have student loans that are going to start being paid in September. I think it's September, maybe it's early October. Anyway, I got more homework to do before I start writing about that, as you can tell. But a lot of these people are going to have to make some tough choices. They're going to have to spend a lot less in other areas, usually on discretionary items, but maybe let that car get repoed and go buy a used one, or default on some credit card debt, or maybe stop paying back their buy now pay later charges. I mean, or just not pay the student loan, and I don't know how they're going to react, but I think the ultimate impact of student loans finally having to be repaid for the first time since COVID, if people do decide to make those payments, that just will mean less money that they have to spend on other stuff, whether it's food or gasoline or groceries or movie tickets or Taylor Swift tickets, right? I don't know. I don't know how that's going to play out, but I don't think it's going to be good overall for consumer spending. And like it or not, consumer spending still makes up, 2/3 of our GDP. So the government has been overspending for the past several quarters, trying to keep GDP going up. But as the government borrows money and spends it and prints more money to spend, they will keep inflation high. So there's a whole lot of factors at play, and I don't know. I don't think the world will end tomorrow or anything, but time to just kind of pay attention to this stuff as we go on and see how the market behaves.
yep. So awesome. Well, thanks, Shane, and I will see you on the next one.
All right, Kyle. Thanks. Bye.
Yep. Bye.